Now, the spotlight is back on the Philippine bond market with global risks, slower growth targets, and governance scandals weighing on sentiment. The Bangko Sentral ng Pilipinas now sees the 6 to 7% growth target slipping to 2027. Yet the bond market remains remarkably resilient, even amid the 100 billion peso flood control scandal. To help us read the risks, reforms, and the opportunities, we're joined by Dino Aquino, the Vice President and Head of Fixed Income at Security Bank. Good morning, Dino. Thank you for being here with us.
Yeah, good morning, Mikey. At least it's green today. Last time it was red.
The main gauge, yeah. But we've got a long ways to go to make people happy in that regard. But let's talk about bonds today. The first half was a pretty volatile period. First quarter was amazing. Second quarter came the risks of higher inflation and the tariff uncertainty and the rate cuts. So that second quarter was softer. Where does the bond market stand today?
There's more clarity approaching the third quarter. As you mentioned, the Fed already reduced their policy rates. BSP is already on an easing cycle, though we still expect one more. So there's clarity that the direction for yields is really on the downside.
And there's clarity that we're still resilient. The 10-year still trading below 6%, that resistance level. Still resilient. Why still resilient?
It's probably because the market is focusing on the fundamentals, the macroeconomic fundamentals, which remain relatively good despite the risk of slower growth.
That's
so
right.
Our inflation remains very benign. It's gonna likely average below the BSP's 2 to 4% target. So that alone is very supportive of the bond market. Plus, as mentioned, I think last time, the inclusion in the JP Morgan index would attract foreign flows coming in. So there's a lot of liquidity to support the market. And for the time being, that's why it's really resilient at this point.
And despite all the negative news, bond markets thrive amidst the liquidity. Even as GDP growth, the BSP now expects the 6 to 7% growth target won't be met until 2027. When it's not exciting for equities, it's exciting for the bond market. Can you tell us more about this?
We don't want to sound like the bad guys here, but when growth... when there's a risk for growth to slow down, the bond markets actually perform better because it would entail the BSP to be very supportive of the monetary policy. That would entail...
They're going to need to. Not just that, possibly a cut in the reserve requirement ratio as well.
More rate cuts, a cut in the reserve requirements, which will be all supportive for bonds to move lower, which is something that the bond traders and the fund managers like.
Moderate growth, messy politics. It just means go to the safe haven.
Safe haven because you have the coupons at the end of the day. So,
overnight, U.S. Fed Chair Jerome Powell, he was, he stuck to his guns, but other members were seeing that they're, becoming more dovish. And with Jerome Powell possibly on the way out, do you think that the tone of the central bank in the U.S., the Fed, would change?
Well, I think he's really on the way out. President Trump is very vocal. I don't know if he saw his tweet that if he doesn't cut 100 basis points, he will fire Powell. But he tweeted that just after the Fed meeting. But if you look at the other, I think during the FOMC meeting, a lot of investors were hoping for more dissenters. There was only one who dissented and voted for a 50 basis points cut. The new guy, Stephen Moran. So. They were expecting Waller and Bowman to probably be a little bit of a dovish tilt there, but they weren't. So that's probably the reason why people viewed the recent Fed meeting as a hawkish cut rather than a dovish cut.
Okay. Now, how does this uncertainty over the U.S. Fed affect peso yields, the peso itself, and even a foreign appetite for our bonds?
It could create some volatility in the short term given the uncertainties when it comes to their rate cut path, especially approaching 2026. But I think it's just temporary. It's just a blip in general, given that the market is very, very liquid at this point. In fact, there's added liquidity coming back to the system. BSP Governor Ramelona issued a statement after the last BSP meeting that they will be unwinding some of their issuance of short-term BSP bills. Currently, there's around 800 billion outstanding BSP bills. They issued 70 billion less this month and likely another same amount probably the next month. So if you just total it, that's about more than 100 billion, 140 billion coming back in to the secondary market. So that with ample liquidity will keep local bonds very much supported.
Okay. Another thing I wanted to talk about, the index inclusion. The Philippines is on JP Morgan's positive watch list
yeah.
For its government bond index emerging markets. If we're included, how much cheaper will our financing get?
If I can't give an exact number because I don't know how much flows will come in at that time, or flows are already starting to come in.
Hard to guess.
Hard to guess.
How will yields move?
I think generally, if I had to make an educated guess, easily 30 to 50 basis points lower in terms of.
Which doesn't seem like much, but that's a lot for bonds.
That's a lot for bonds. That's actually a big deal for bonds because, for example, if your 10-year is at 5.5, it will go to 5. That's a big deal. Right?
Okay, so there's that, and that's our resilience to the scandals, all the corruption scandals, the 100 billion flood control scandal, the political noise. The markets have remained so resilient. What should CEOs, what should the business community take from this?
I think they should lock in rates as everything is still relatively high at this point. I remember our very first guesting, I probably was the only bond bull in the market at that time. But now everyone's trying to get their hands on bonds. But I think anything with a 6% handle is very attractive. So even for the retail investors, in fact, I'll put my sales space on right now. We're actually offering Security Bank bonds, 5-year bonds at 6%. If you recall, during our last interview, before the RTB issuance, I said the RTB at 6% is very, very attractive.
Okay.
And it's now trading at around 5.78, 5.80. So people who bought RTBs at that time were rewarded with a very good return.
So whether
already.
you're a CEO, a CFO, or a retail investor, now is the time to lock in bonds. Even as expectations for GDP could be revised lower. Even as, and with that said, interest rates, BSP is going to be more supportive. So because the yields
will
may not
move lower.
The yields will move lower. So now is that time.
Now is the time.
Okay. On another front, I wanted to talk to you about the government. They plan to raise 627 billion in foreign debt next year, government borrowing for 2026. With global uncertainties, how do you expect the appetite for peso and foreign currency bonds to hold up? Well.
Yeah, I think it will hold up well. As long as these issues are not disruptive, it's not really disruptive. It's more of
just noise.
Just noise, yeah.
Focus on the fundamentals.
Yeah, focus on the fundamentals. In fact, our JP Morgan inclusion was announced this month, despite the noise, right?
Correct.
So they don't really look at that.
To show it goes the other direction.
And we've been through a lot of these noise from the past, and the bond market hasn't really been affected that much.
On another front, Congress recently slashed by 255 billion from the DPWH budget after double entries and repeat funding were uncovered. What does this say about the fragility in our fiscal credibility?
It's hard to tell at this point, but if you just too soon. But if you just break it down to the basics, it would mean less government spending, less government investment. So that would entail risk to slower growth, which again, unfortunately, the bond markets would relish on.
Okay, looking out to 2026, heavy borrowing needs, index inclusion, and growth risks. Where do you see the 10-year benchmark trading, and what's the implication for corporate loan rates?
It will likely move lower to around the 5.5 handles, given that the BSP is set to reduce one more this year and probably another 25 to 50 next year because of benign inflation, and we have to support growth. So we'll likely see a lot of the bond yields in the yield curve trading below 6 next year.
Okay, and as we step into this, really step into this second half and look towards 2026, how would you describe the state of our markets today?
Well, it's been a roller coaster ride. So basically, if you look at it, it's just really a roller coaster ride. But at least it's finding its footing. It's finding some clarity. It's finding some direction already. Yeah.
Okay, all right. Dino Aquino,
Yeah,
thank you for your time today, the Vice President and Head of Fixed Income at Security Bank.
Thanks for having me again.